Hello, good evening. I'm Radul Mishra from the corporate communication team, and on behalf of CareEdge, I welcome you to our today's discussion on tires, rolling ahead with caution, and we sincerely appreciate our time for joining us on this webinar. We would like to welcome our esteemed guest speakers for today, Mr. Kumar Subbiah, Executive Director of Finance and Chief Financial Officer at CEAT Limited, Mr. Sanjeev Aggarwal, Chief Financial Officer, JK Tyres and Industries Limited. The session will be moderated by Mr. Bhagavath, Senior Director at CareEdge Ratings. We'll commence the session with a presentation by Rapleen Sethi, who's Associate Director at CareEdge Ratings, which will be followed by a panel discussion and thereafter a Q&A session with the audience. In case of any questions, you are please requested to key in your panel. May I invite Rapleen to begin with the presentation, please?
Thank you, Mradul. Good afternoon, everyone. The tire industry is gaining scale with increased demand from domestic OEMs and replacement segments aiding volume and price growth. Exports have been on the rise too, but the cost pressure seems to be an overhang. The steep and the swift commodity inflation has been a dampener despite the growth in volumes and price hikes for the last few quarters in the tire industry. However, the easing of the cost of the synthetic rubber and natural rubber along with the carbon black has brought some relief of late. We at CareEdge thought that with tire industry being at an interesting turn, this is an opportune time to host a webinar where we can share our perspective on the sector and understand from the industry experts as to what lies ahead for the tire sector. To set the context for the presentation, the key messages are the demand is expected to rise by 5 to 6% unit-wise year-on-year in FY23 on the high base of FY22. Import restrictions continue to act as key catalyst for the players. The rising export levels have opened newer opportunities for the domestic players. Input price rise has been straining the industry's profitability despite the price hikes taken by players. These are now waning off, which is expected to result in sequential improvement in the profitability. Considering the cost pressures, there will be moderation in the profitability and the leverage position of the players in FY23. Given the strong demand prospects, the capex cycle may revive, which will be a key monitorable. FY20 and 21 have been very challenging years for the domestic auto and tire industry. This is presented in Exhibit 1, wherein the production volumes of automobile and tire is shown. And in Exhibit 2, we have shown year-on-year percentage change in production trends in auto and tire industry by major categories. Though the OEMs account for 25 to 28% of the total domestic tire consumption, there is a direct correlation between tire consumption and OEM production growths. Post recording the volume growth in fiscal 2018 and 19, auto industry went into a downturn, recording a sharp volume degrowth. The biggest dent was felt in the commercial vehicle industry, which contracted by 32% and 17% year-on-year in both the years respectively. Demand was dented by multiple headwinds like the NBFC's liquidity crisis, easing of the axle norms, increased vehicle costs due to BS6 transition and higher insurance premium, and economic contraction. Making it worse was the COVID-19 pandemic hit the last nail, resulting volumes dropping significantly. Consequently, the tire industry also reported a degrowth. Since replacement markets has a higher share in the overall pie of the tire demand, it insulates the tire industry from the cyclicality to a large extent. Tire industry contracted by 8% and 4.4% respectively in fiscal 20 and 21, as against the auto industry, which contracted by 14.8 and 14% in similar periods. However, with auto demand recovering swiftly in the second half of fiscal 21 and financial year 2022, tire industry also recorded growth, and the bounce back was higher than the auto industry. This was primarily aided due to stronger recovery in the replacement segment. The growth momentum is continuing in the current fiscal as well. Having looked at the total tire production, let us now look at the production trend by categories over the years. Exhibit 3 shows the tire production trends and volumes in each of the year was registering growth excepting FY20 and FY21. Thereafter, industry recorded 13% growth in FY22 production numbers and the total production volume reached the pre-COVID levels. The lower base in FY21, preference for the personal mobility and improving pace of vaccination with healthy rural cash flows and normal monsoons were the reasons of recovery in demand. The 2-3-wheeler tires are the largest category by volumes with annual production of about close to 90 to 100 million tires every year, followed by the passenger cars, while the truck and the bus is, however, the largest category in terms of tonnage and therefore the revenue, which is 50% of the industry's share. FY22 production rebound was driven largely by commercial vehicle, which grew by 14% year-on-year, and passenger vehicle, which grew by 31% year-on-year. Even the 2-3-wheelers registered a 6% growth. Going forward, we expect a higher sale from passenger vehicle and commercial vehicle segments. Considering the average life cycle of tires is 4 to 5 years, while vehicles are generally for longer time period, thus the key to understand the demand is its replacement market. In Exhibit 4, we can see that the tire industry mix is dominated by the replacement segment, which is 58 to 60%, followed by the OEM, which stands at 25 to 28%, and balance 11 to 13% is exports. The share of exports have increased in last 1 year. Exhibit 5 shows the segment-wise share of replacement demand, which is the average of last 6 years, and the truck and bus, which is the commercial vehicle segment, has the highest share from the replacement market, which is 80%, followed by the passenger vehicle, which has 60% replacement market share, and then the 2-3-wheeler and tractor tires having 52 and 45% respectively. The tire industry follows the commercial vehicle cycle in India, which is presented in Exhibit 6 below. The truck and bus is the largest category in terms of tonnage for tire industry. An increase in the economic activity triggers the tire replacement demand for CVs as freight movement increases in the first phase. And then with the start of the CV cycle, the OEM demand for CV tires also gets boosted. Further, the low penetration of the passenger vehicle in India vis-a-vis other countries is also the reason the tire industry cycle takes the course of CV cycle in India. Also, CV in India contributes close to 55 to 60% of the industry's tire demand, while globally this segment is around 25 to 30% of the industry tonnage. Having looked at the category-wise demand, let us see the trends in the demand of tires from the end-user segments over the years in Exhibit 7. The blue portion on the bars is presenting the OEM demand. Broad-based growth in automobile sales fueled the healthy growth in OEM demand during the last cycle till FY19. And after declining sharply over FY20 and 21, the OEM demand recovered strongly in FY22. The momentum is expected to be maintained over the medium term. Factors like easing supply-related headwinds in passenger vehicle, the 2-3-wheeler improved demand prospects due to reopening of the schools and colleges, strong growth as expected in the commercial vehicle segment will support the OE demand. The rising inflation and interest rate hikes may partially constrain the growth. Replacement, which forms 2/3 of the demand, which is presented by the green portion on the bars, is also expected to register growth, though a single-digit growth is expected owing to the high base of FY22, wherein the replacement market registered an almost 13% year-on-year growth. Higher share of replacement market cushioned the overall contraction in 20 and 21 and aided a stronger rebound in FY22. Further, the measures like import duties and restrictions led to a sharp decline in import of tires in 21 and 22, which we would understand in a little more detail in the upcoming presentation. This also helped the domestic replacement tire industry. Now, tire exports, which is the third category in the end-user segment, is presented by grey portion on the bars in Exhibit 7. And it registered a robust growth in FY22, which is 90% with healthy demand from key export destinations like US and Europe. The macro headwinds may impact export to an extent, so year-on-year not much growth is expected over a high base of FY22. Put together all three segments and considering the inflation and global headwind scenario, rising rate hikes, etc., we are expecting a 5 to 6% year-on-year volume growth unit-wise in demand over the next 2 years. Moving on to imports, Exhibit 8 and 9 show the trend in import volume and value-wise respectively. India import tires from over 50 countries, though largely from China, Thailand and Vietnam. The Indian tire industry has been beneficiary of import duties and restrictions levied by the Government of India on cheap imported tires, particularly from China and Thailand. As can be observed in Exhibit 8, a significant dip in total tire import across all categories was registered. From 9 to 10 million tires in years until FY20, volumes dipped to 2.1 to 2.6 in fiscal of 21 and 22. Value-wise, highest imports in the past was truck and bus radial and passenger car radial. Previously, there was significant surge in the Chinese imports due to high anti-dumping duties imposed by US, simultaneously with relaxation of the anti-dumping duty by India in September of 2014. This led to price differential of 35 to 40% between the imported Chinese tire vis-a-vis the domestically manufactured one, and the import of TBR began to rise from a million annual tires to 1.5 to 1.6 million tires in FY16 and FY17. This is exhibited by blue line in the graph below, showing the truck and the bus tire imports. Notably, the import of TBR tires from China declined post-demonetization. However, this was short-lived as imports started to gather pace again in FY18 and there were over a million tires. This was causing damage to the domestic players, and so as a measure to protect the industry, government through constant imposition of anti-dumping duty and countervailing duty on commercial vehicle tires imports helped curb the imports over the last 3 to 4 years. The restrictions on tire imports by DGFT from August 2020 acted as a further catalyst and boosted the domestic manufacturing. Even value-wise, we can see the significant dip in imports from Exhibit 9. Value-wise, tire imports seem to be higher than volume in H1 of FY23, primarily on account of the price hike taken by the tire companies world over and depreciating rupee. Now taking a look at the export scenario from India, if we see on Exhibit 10, historically the export volumes have been muted at 14 to 15 million tires annually, wherein the agri tires used to have the largest pie. The slowdown in the global auto scenario, higher share of Chinese exports in global tire imports, and thereafter COVID impact were the larger reasons of muted export levels. In FY22, the Indian tire industry and exports also witnessed tremendous growth in volume by around 90% to 30.5 million tires in FY22. And there was no single segment growth driver. It was a secular growth across all segments, as can be seen. Among the major export demand drivers have been the increasing adoption of China Plus One policy, the stringent anti-dumping duties against the once dominant Chinese products, and efforts by the players to enhance the exports mainly to offset the poor consumer sentiment in the country. Further, the faster recovery from the pandemic-led demand depression by Europe and North American markets were also the reasons for export surging. The overseas market not only resumed the business and operations at a faster pace compared to the domestic market, but also provided better price realizations despite the commodity price inflation. Though the growth in exports may be modest over the medium term, marked by high inflation and geopolitical issues, along with a high base effect, however, the Indian tire companies have become more dominant export players. Similarly, the value-wise exports have also rose by almost 50% to over 20,000 crores. Just to have a granular look at tire exports, traditionally the farm and the agri tires and the OTR and in the industrial tires have been the most exported categories. But in recent years, even the TBR tires were also rising, as can be observed in Exhibit 11. Even in H1 of FY23, we are witnessing continued growth momentum in exports. Though India sells to more than 170 countries, the major destinations have been US with almost a share of 19%, Germany being the second with a share of 7%, and Brazil, France, and Bangladesh have 4% each. Exports in the past used to contribute about 20% of the industry's revenue, as shown in Exhibit 13 below. But with volumes registering a robust growth, export as a percentage of overall revenue for the industry has increased from 19% in FY18 to 27% in FY22. Having looked at the tire imports and export trends in the industry, let us take a closer look at the investments in the gross block by the players to be able to meet the demand. Tire industry has installed significant capacities over the last 5 years through FY22. The gross block of the industry has almost doubled, as shown in Exhibit 14. Industry used to spend usually in the range of 8 to 13% of its turnover to cater to the rising tire demand in domestic and global markets. FY20 particularly witnessed a large capex on the back of all-time high automobile sale in FY19. However, the macro headwinds in 20 and COVID-19 couldn't let the tire companies accrue the expected benefits timely. Significant moderation in the profitability margins and resultant impact on the cash flows have led the companies to tread towards future capex plans cautiously in FY21 and 22. Most tire players are currently operating at 80% plus utilization levels owing to favorable demand prospects, which was filled by the import restrictions and also pick up in the export volumes. This implies that the players will have to invest in building capacity further in due course. Yet, players will either resort to sweating their current fixed assets to improve the returns or engage in further capex, or may combine both. Though some of the investments would be funded from internal accruals, companies would resort to debt also, since weaker margins in the past 1.5 years have limited the cash flow generation. Hence, companies are currently either trying to debottleneck and scale down the pace of capex before the improvement in the cash flows are tangible. Also, going forward, capex as a percentage of revenue is expected to come down as the base revenue has significantly increased from the levels in the earlier years, owing to the average sale price increase in the last 1.5 years, owing to the cost pressures. We expect the industry capex to be around 4,000 to 5,000 crores annually for the next 2 years. Moving to the cost side of the industry, the battle that sector has been battling with for last 7 to 8 quarters. In Exhibit 15, the raw material breakup is shown, wherein the natural rubber and synthetic rubber alone account for 47% of the cost, followed by the crude derivatives like carbon black, which makes up another 25 to 27% of the cost. A relentless rise in the raw material prices, that is, of natural rubber, synthetic rubber, and carbon black, have been observed over the past few quarters. Deficit in supply of the natural rubber on account of the erratic seasonal rains in key rubber producing geographies, COVID-19 lockdowns, strong demand from China, which consumes more than 40% of the global rubber produced, had led to strengthening of the natural rubber prices both globally and domestic markets in the past. The import duty and restrictions, along with acute container shortages and higher freight rates, kept imported natural rubber expensive, thus also allowing the higher domestic natural rubber prices as well. Domestic natural rubber prices were already ruling at Rs 140 per kg pre-COVID in H1 of FY20. And when COVID stuck, the prices dropped initially for H1 FY21 in the range of 120 to 130 per kg, but rose continuously thereafter, with prices even peaking at over 175 per kg levels in Q3 of FY22. The same is evident in Exhibit 16. Similarly, the Russian-Ukraine war was tremendously pushed up the prices of crude to above $100 per barrel, leading to hardening of the synthetic rubber and other crude derivatives-based raw material prices. The reversal in the crude prices following the recessionary expectations in key global economies and resultantly lower freight rates, allowing higher natural rubber imports by domestic companies, has resulted in twin benefits for Indian tire manufacturer players recently. That is, falling natural rubber prices and even the synthetic rubber prices. Further, rising COVID-19 infections in China has resulted in total lockdown in various parts of China under the zero COVID policy, which also resulted in the softer demand from China and consequently tapering both the crude oil and the natural rubber prices. The industry is expected to witness lower raw material prices and benefits from Q4 of FY23 in particular, after utilizing its high-cost inventory in the third quarter. The Exhibit 18 represents the quarterly performance of the industry in terms of revenue and margins. The industry recorded significant downfall in revenue in Q1 of FY21 by about 44% year-on-year. And post that, the replacement market tremendously helped the industry, posting revenue growth from Q2 of FY21 till the latest quarter. We would see sharp rise in certain quarters, majorly on account of the low base effect, which makes year-on-year quarterly performance disparate. Q1 of FY22, despite having witnessed a catastrophic second COVID-19 wave in India, grew by 84% year-on-year, majorly due to lockdowns being implemented, pragmatically keeping both human lives and economy in mind, thus not washing out the operations. Post that, the opening of the economy, price hikes, and healthy replacement OEM and export demand has helped the industry record double-digit quarterly revenue growth year-on-year. Despite the strong demand observed, the tire players are simultaneously facing steep cost curves, as stated earlier. This has resulted in fall in margins over 7 straight quarters through Q2 of FY23, as seen in Exhibit 19. You can observe that the rise in rubber prices, highlighted in green line, having inverse correlation with operating profitability, which is depicted by the blue line. There is generally a lag of a quarter in the effective pass-through of the raw material prices, majorly due to industry storing inventory. The operating profitability was particularly impacted more post the Ukraine-Russia war in Q4 of FY22, which led to disruptions in the crude oil market, leading to the crude oil prices to over $100 per barrel in Q1 of FY23. Now the prices have softened and we are expecting a sequential improvement in the quarterly profitability margins. The raw material costs have come down from the recent peaks. They are still above the pre-COVID levels. And for now, the operating profitability on a full year basis is expected to moderate in FY23, and it would be below the historical levels as shown in Exhibit 20. Lower margins have also led to lower levels of ROCEs, and these are despite the price hikes taken by the players, which shows that how strong the cost pressures were faced by the industry. Also, the leverage in the tire industry historically has been a little higher. The deterioration in the profitability has moderated the debt coverage metrics in 23 with the EBITDA and trust coverage and the total debt to EBITDA, as can be seen in Exhibit 21. And this is despite the companies being cautious of their capex plans in 23. Assuming the industry players sticking with the current pricing and the debt coverage metrics would improve from FY24 with benefits of the lower cost improving profitability and cautious capex plans so far. Moving on, this slide presents the rating dispersion of the entities in the tire industry, rated by CARE, outstanding as on a particular date. As can be observed, all tire manufacturers are in investment grade category, resembling the healthy credit strength of the industry. Even in investment grade, 11 out of 13 companies are in A or above band, thus being in a low credit risk category. The sector is largely organized with limited number of private players operating at large scale with healthy balance sheets and financial flexibilities. Limited capex being undertaken in the near to medium term, and with cross pressures now cooling off, no major deterioration is largely expected in the fin risk profile of these players. Considering all the factors in play, we at CareEdge have a stable outlook on the sector. Indian industry has emerged as a key tire exporter. Further, there is currently low threat of imports, but the continuation of the duties and restrictions are imperative. Further, with the commercial vehicle cycle in play, the Indian tire industry is likely to witness healthy domestic demand going forward. However, the rising inflation, the rate hikes, and the geopolitical crisis are expected to constrain the growth in demand to a single-digit unit-wise. Margins have registered a sequential decline over the past few quarters, but should improve given the easing in the key cost inputs. And managing the capex amid moderation in the profitability of the players and any geopolitical macro headwinds remain a key monitorable for the sector. With this, we come to end of our presentation. Thank you, everyone. I now hand over to Mradul to take the session forward. Over to you, Mradul.
Thank you, Ravleen. Now, may I invite Mr. Padmanabh Bhagavath to take over the session, please? Mr. Bhagavath is a senior director at CareEdge, handling large corporate ratings. He has over 25 years of experience in credit risk assessment across sectors, including corporates, banks, global financial institutions, and sovereigns. Prior to joining CareEdge, he worked with ICICI Bank Limited and Mahindra & Mahindra Limited. He holds a bachelor's degree in production engineering, a postgraduate degree in management of business finance, and a cost and management accountant. Over to you, sir.
Thank you, Mradul. And thank you, Ravleen, on a detailed presentation covering all aspects. Just to sum it up, we at CARE Rating have a stable outlook on the tire industry. There are various tailwinds and headwinds the industry is facing. Demand looks promising. However, the global inflation may taper export growth. Also, we are at the cusp of a turnaround of margins for the industry players after the recent softening of cost for some of the raw materials. With this, we would now like to understand the views of industry experts on various aspects impacting tire industry. I would like to take this opportunity, and it's my great pleasure to introduce our esteemed panel. Our guest today is Mr. Kumar Subbiah, Executive Director Finance and Chief Financial Officer at CEAT Limited. Mr. Kumar has been in CEAT for about last 7 years. Prior to that, he has spent over 20 years with Unilever Group, where he handled various finance and commercial roles in and outside India. His last role at Unilever before joining CEAT was Finance Director Supply Chain for Southeast Asia based at Singapore. Mr. Kumar is a chartered accountant and a cost accountant with professional interests both in finance and supply chain. Good to have you as a panel speaker, Mr. Kumar.
Thank you. Thanks for having me on your show. Thank you.
Our next guest is Mr. Sanjeev Aggarwal, Chief Financial Officer at JK Tyre and Industries Limited. Mr. Aggarwal has over 28 years of rich and varied experience in finance domain, including raising equity funding, long-term debt for projects, working capital management, trade finance, and structured finance. Prior to joining JK Tyre, Mr. Aggarwal has worked for companies like Penna Cement, Lovelock and Lewis, BC Jindal Group of Companies, Acme Power, and Indorama Synthetics. Mr. Aggarwal was conferred the title of most influential CFOs of India by Chartered Institute of Management Accountants in June 2016. He is a rank holder chartered accountant. Glad to have you as our panel speaker, Mr. Aggarwal.
Thank you. Thank you so much. My pleasure to be on the show.
I would like to initiate the discussion with understanding the domestic demand currently. Let me seek views from Mr. Kumar. Are we expecting the industry to touch new highs in FY24 supported by healthy demand in both OEMs and replacement market? And would it be sustainable for a couple of years more?
The tire demand is largely linked to how economy is doing. So from that standpoint, Indian economy is expected to grow. So, and therefore, we expect our tire industry also to grow in line with the growth in our GDP. If we really break our, the local demand into two, one is what gets consumed in the after-sales market and what is consumed by original equipment manufacturers. The replacement demand or aftermarket demand would normally follow the growth in GDP, maybe a percentage or two more than that. So therefore, we expect that to grow. As far as original equipment manufacturers are concerned, we are seeing some traction particularly in the last 2 to 3 quarters from the passenger car manufacturers, thanks to improved availability of chips, and prior to that, the production suffered, and also in the high-end two-wheeler segment. As far as the commercial category is concerned, generally the demand swings. Okay, there's some bit of seasonality there. So overall, just to sum up, I think we expect growth to be reasonable in the coming 2 years in the local market. In the international market, maybe the situation could be different. That's the way I would like to summarize, Mr. Bhagavath.
Good, great. So let me take the views of Mr. Aggarwal on the export side of demand. Macroeconomic headwinds in Europe amidst continuing war is expected to be pretty challenging for the tire demand in the key export markets. Do we expect any moderation in overall demand? In what way this would impact the Indian tire industry as such? You'll have to unmute yourself, Mr. Sanjeev.
Sorry. So in fact, I would say that yes, in the near term, there could be some challenges because what we are seeing and noticing in the global economy at the moment, various challenges are facing us, including the inflation, the high rate of interest scenario, increased energy prices due to Russia-Ukraine conflict, which was very well covered by Ravleen in her presentation. But in spite of that, what we have also noticed is that there is a continuous growth in the exports from India. And that was about 50% in FY22, which of course included some part of the increase in prices and some part increase in volume. And in this financial year also, in the first quarter itself, we have seen the 31% increase in exports were there. And again, to some extent, it was due to the increase in prices. But what we have seen, 2-3 things I would like to highlight is that one, that the Indian-made tires are very well accepted across the globe due to its high quality and competitive prices, number one. Number two, Indian tire manufacturers have developed R&D capabilities over the years such that we are in a position to produce high-quality tires consistently, technologically advanced tires for the domestic and export markets, and the world has accepted it very well. So these are some of the reasons probably which indicates to the fact that there will continuously be a case of the Indian manufacturers making inroads into the international markets and the new markets, apart from what we are exporting to almost about 170 countries at the moment. So I am very hopeful that we will continue to progress well on the export front, except maybe in the first half of the next calendar year, which could be slightly slowing down. But post that, there would continue to be a good growth in the industry, in the exports.
Got it. Mr. Kumar, let me take your views on the import restrictions. Import restrictions have acted as a catalyst for the tire industry in terms of volume growth. What are your thoughts going forward for the industry as a whole? Will the imports be under control even after the restrictions are removed, especially the commercial vehicle and passenger vehicle tires?
Okay, see, there are two types. of controls. In case of commercial category of tires, as you also covered in the earlier analysis of the industry, okay, the exports or import shifted from China to Southeast Asian countries. Okay, so and we have the government introduced anti-dumping duty on import of tires from China. Okay, and therefore that led to some shift happening from that part of the world to Southeast Asia. Okay, and during COVID period, government also introduced some restriction in terms of licensing for import of tires, which is predominantly would have had some impact on the import of passenger car radial tires. So not much shift has happened in case of truck and bus radial tires. From tire industry perspective, okay, the restriction, I would say, particularly the tariff kind of a barrier, okay, is only to bring some level playing field. Okay, and import of raw materials attract a very a higher rate of duties. A lot of our raw materials attract anti-dumping duties, safeguard duties. Rubber itself is 27% plus duties. Whereas the tires are coming from some of these countries because of FTA with these countries at 5% and 6%. So therefore, except this little bit of anti-dumping duty on import from China, all other countries, they have advantage because of the fact that the tire is subject to inverted duty structure. So therefore, there is some disadvantage for the tire industry whenever imports happen, because there's no level playing field when you import tires from FTA countries. Going forward, I don't think there is going to be any incremental volumes because of the fact that the base itself, particularly in the passenger car, it is already part of the base and part of year 2021 base mostly, and less of year 21-22 base. I don't think that's really going to drive any growth. Okay, whereas the reverse could happen from India, as Mr. Aggarwal also mentioned about Indian manufacturers are now capable of producing tires meeting the specifications of best automobile manufacturers in the world. So from their point of view, the reverse movement could happen in the sense that India could be a good base for the purpose of exports, and there may not be any material impact on account of any restrictions on import of tires as far as going into the FY 23-24 is concerned.
Yeah, good to hear, Mr. Kumar. Mr. Aggarwal, we know India is also facing inflation above the target band of RBI, for which the RBI recently hiked repo rate by 35 basis points. With inflationary pressures, how is the pricing trajectory expected to be considering softening of raw material prices? Will the industry pass off the same to the customers, especially in the replacement category going ahead?
I hope so. In fact, as you are aware, in the last 7 quarters, almost about 7 quarters, industry has seen unprecedented increase in the raw material prices, which is to the extent up to about 50% of the cost, right, in raw material costs. So which had an impact of almost about 34% on the selling prices. And it could be different for different players slightly. But and the majority of that we were able to pass on, which was almost about 2/3 of that. But still there is an under recovery to the extent of almost about varying for different products between 8 to 11%. And we would like to, of course, pass it on to the customers, but subject to, of course, the market dynamics for each of the segments, for each of the SKUs, how we can pass on, how much we can pass on, how much is the demand. But the good thing is that today we are seeing a buoyant demand condition in the market, and we hope that we will be able to pass on to a large extent. And this is again subject to the market dynamics. So I hope we will be able to pass on as an industry, but let us see how much it would be, because this is still a very large gap, and already there is a softening in prices, and this will definitely lead to increase in operating margins. But to what extent it will be, it's a time only will tell.
Similar question to you, Mr. Kumar. As Mr. Aggarwal has said, the cost has been escalating. So if I can take your views on the cost that the industry is battling with, the raw material costs are showing some signs of cooling down. However, the overall profitability of the industry is also dependent on OEM or replacement mix or USD-INR exchange rates, premium versus value play, etc. So, to what extent you feel the EBITDA margins on an average could improve for the industry as such?
Okay, no, I just want to give some background to this. Any movement in the raw material prices, let's assume currently we are seeing some softness in the raw material prices. For a short period of time, will have very limited impact. Okay, it needs to sustain for a period of time. Okay, and last 7 to 8 quarters, consistently we saw raw material prices going up quarter after quarter. Okay, and a lot of our raw materials that we buy, okay, we have an arrangement whereby the prices get adjusted based on how the feedstocks that go into the manufacture of raw materials have moved. Okay, sometimes it's possible that crude oil prices have corrected, but the crude oil derivative that goes into the manufacture of one of the raw material prices need not have necessarily moved in the same proportion. One, and number two, it's more about how things have moved in the previous quarter. So therefore, there is a lag for any raw material cost to impact. One, and number two, all of us, all the entire industry carries reasonable amount of finished goods. So that in the pipeline you have raw materials. Some of the raw materials are imported, so therefore you import those raw materials well in advance, 2 months, 3 months in advance. So in the pipeline you always have those raw materials which will come and hit you. The benefit of drop in raw materials, one, will have to sustain for a reasonable period of time. For it to flow into our own margins and cost of production, it takes some time. And while the base price of raw material prices in dollars, we have seen some correction. But if we were to convert that into rupees per kg, we also need to take into consideration the depreciation of rupee that we saw in the last 2 to 3 months. So overall, I think the larger answer is that it's good to see some correction in raw material prices after a long gap, after 7-8 quarters of gap. Okay, so therefore, and number two, there has been a lag. We have not yet passed on the impact of raw material costs to our customers in this period because of continuous increase in the raw material prices. Second, I also want to bring it to the attention of everyone here. Look, our industry is a capital-intensive industry. Okay, so therefore, for us, and considering low asset turnover ratios, okay, it's important that we make reasonable amount of margins so that we are able to service the capital reasonably. So we are still at far lower than even the normal levels of margins. So therefore, there's some catch-up. Hopefully, if the raw material prices remain at the current level or there's going to be some more correction, I think it's going to be good in terms of expansion of margins. It's not that we're going to be very profitable. It will only help us to reach some reasonable level of margins so that helps us to service our capital and the debt that we carry in our books, okay, and mostly used to fund our capex. So therefore, we expect margins to improve. Okay, hopefully costs continue to be at current level, and with that, we hope to see progressively improvement in margins. But I don't know how much. It all depends on how things unfold. But it looks positive.
Good, great. And continuing with the raw material costs, and it's not receding, so raw material costs remains a prominent issue. Mr. Aggarwal, among the various reasons for softening raw material prices has been the weak Chinese demand on account of protracted softening raw material prices, lockdowns, and COVID-19 infections in China. So just wanted to understand how important a factor would be the Chinese economy towards the raw material prices in the near term. Do you see prices staying at current levels? Mr. Aggarwal, unmute yourself.
I'm so sorry. So Chinese factor is definitely very, very important, Mr. Bhagavath. And in fact, we have seen that China is the largest commodity consumer, and with any slightly downward consumption in China lead to reduction in the commodity prices. And at this point in time, in fact, this is added with the likely recessionary conditions or slowdown globally. particularly in Europe and the US. And that is the reason why we have seen that the Brent crude oil prices, which were at some point in time in June, were at about $125, have now come down to almost about 75 to 80. It's hovering between this range due to the weak demand and the fear of global recession and the weak data globally. So I believe that if China opens up again, and there was a report in today's newspaper also, I was seeing that Bank of America has been talking about like about $90 per barrel kind of the crude oil price. So there will be a volatility to my mind in the near term, and the crude oil prices and the natural rubber prices and synthetic rubber prices and other prices will of course remain volatile. But of course, in the medium to long term, I think broadly this is going to settle down at the level of let's say in the case of natural rubber, almost about 150. This is my expectation, and raw material prices will also remain slightly softer than what it was earlier in the financial year 22 and thereafter in the first 6 months. So we hope that this will settle down at a good, reasonable level so that we can see some improvement in margins going forward.
Sure, got it. Let me take some views on the capex the industry is looking at. Mr. Kumar, Indian automobile OEM industry and particularly the commercial vehicles segment is expected to show healthy growth over the medium term. However, does the industry have the installed capacity to cater to the growth? What kind of capex will be required for the industry to cater to the next level of growth? Similarly, can you give your views on the passenger vehicles as well?
The capacity means you are talking about tire industry capacity or auto industry?
Tire industry.
Yeah, tire industry. See, I think it was also presented by your team in terms of how the industry has been investing in the last 4 or 5 years or so. I think the amount of capex that tire industry would have put in the last 5 years would have been higher than what it would have put in the previous 15 years. So that's the level of capex. And capex is also linked to what world wants from India. Okay, and so one of the trends that we see is that world is looking for an alternate to China. Okay, and particularly from tire space, India is in a good position to compete with China on as far as tires are concerned, because we produce good quality tires. We supply to top end OEM manufacturers. Okay, and therefore our tires have been proved in the developed markets well. So therefore, capex is also a function of what ambitions that Indian tire industry has in the overseas market in addition to the local market. And if you ask overall in the order of priority, having put in capex, the priority number one is to see how to utilize the capacities first, because a lot of capacities have been added by different players, possibly in different segments depending on the leadership position in the different categories by tire companies. So therefore, that's a priority number one. Priority number two, obviously, is to add capacities in line with this. As far as tire industry is concerned, to my knowledge, overall capacities that we have added in the last 3 to 5 years should be adequate in terms of meeting large part of the growth of next 2 to 3 years. That's the way we see. Okay, in the event auto industry grows faster than our current anticipated levels, I think in that case, maybe additional capacity additions will happen. One, and number two, capacity ability to invest in capacities also depends on the profitability of the business. Okay, so it's very unlikely that if margins continue to be what we had seen in the last 7 quarters, for any tire player to go and invest more money in the future. So therefore, should the margins improve in the coming quarters, thanks to some softness that we are seeing in raw material prices, which we hope it continues, it's possible that more investments would come. Overall, I think adequate capacities have been built in overall at the industry level to meet the requirements of both local as well as international, at least to the extent of next 2 years.
Great. I would like to take views from both the panelists on the electrification and its impact. We all know amidst the global warming and increasing thrust towards sustainable solutions, the world and India is moving towards greener vehicles. Though the EV sales comparatively is small currently, but it is expected to explode over the long term. Hence, related to this, can you provide a perspective on how the electrification of vehicles may impact the Indian tire industry per se over the long term? What kind of opportunities and threats are expected from this change? Mr. Kumar, if you can go first.
No, sure. See, electric vehicle we are seeing traction, okay, in the EV vehicles market. The percentage growth still looks good purely because the base level is very, very small. So from that point of view, percentage looks fine. I think as per our own understanding, how we see EV vehicles evolution is it's going to be more in two-wheelers followed by passenger, then commercial. I think that's the way we are seeing in terms of evolution of EV vehicles. Okay, at this point in time, okay, the base is still small. In general, tire industry with the existing infrastructure should be able to produce tires in terms of meeting the requirement of EV vehicles. Again, EV, if you look at the consumption pattern, is going to be initially more of OEMs, and with some lag, it'll have some impact on the replacement because the tires will have to be due for replacement. It takes some time, depending on the category of tires. It could take anywhere 3 and 4 years for those tires to get replaced. The specification of the tires that go into the electric vehicles, okay, there are some differences between the tires that go into the normal vehicles. Okay, so that it will be little heavier tires. It may have little more stringent norms with respect to rolling resistance and things like that. I think tire industry is geared up overall to meet any demand that will come from EV. We expect EV to grow. It's good from sustainability point of view. Okay, and we're seeing a lot of interest, particularly in the passenger vehicle side of late. Two-wheelers, a lot of new capacities have been added. Passenger vehicles, some of them have started doing well in the metro segments. So it's an important segment, but it will still be a small percentage of our revenue, considering that the base is small.
Mr. Aggarwal, your views on electrification?
Yeah, I agree with Mr. Kumar. In fact, most of the companies are ready with the capabilities to produce EV vehicle tires. And so is the case that most of the companies have started investing into development of the tires or for the purpose of development of and design of the tires. And also they have added the testing equipments to their kitty. So probably the low resistance coefficient which is needed, or the low noise which is needed, and the kind of the tires which are required, this is going to be a evolution journey. And I think we are all, as an industry, we are all ready, and we will be able to supply tires as per the requirement.
Thank you so much, Aggarwalji. I'm sure the audience has been anxiously waiting with some questions. We can have the Q&A session and request participants to key in the queries in your panel. Madhur, can you announce to the participants?
Sure. Dear participants, you can please key in your queries in case you have any for a panelist. Thank you.
I think there is one question. I think Mr. Aggarwal can take this. Can the current environment be an opportunity for Indian manufacturers to gain market share in the export markets, considering cost competitiveness? What kind of cost differential would be there for Indian manufacturers in EU and US against the established players there?
Okay, so I will say that the cost differential is quite good, and we are very competitive as far as the Europe and the American markets are concerned, and that is the reason why we've been able to actually service those markets in a big way. And the growth momentum is also very good in the last couple of years as far as the export to these countries are concerned. And with the increasing cost in Europe particularly, I think we are much more cost competitive now. And the quality is very well established. The Indian-made tires are very well accepted across the globe, including in Europe and America. And in fact, in the last 6 months, particularly in the first half of FY23, the percentage share of exports to Europe and America has already gone up from almost about 50% to plus 60%. So we will continue to export, and we are quite competitive. The cost differential is quite substantial, but as far as the Southeast Asian suppliers are concerned, of course, there is still a gap, and which we can overcome by way of maybe some corrections or support provided by the government in terms of PLI or in terms of the ocean freight reduction or maybe the port efficiency improvement. So all those factors can go a long way in making us more competitive in those markets to compete with the Southeast Asian suppliers, exporters.
Yeah, thanks for that, Mr. Aggarwal. I think there is an interesting question. Mr. Kumar, if you can take this. Is there something the tire industry has been focusing on to reduce rubber import dependence? Are there any adequate efforts from the government as well?
Yes. India produces about 700,000 tons of natural rubber. Okay, and if we produce more tires, obviously we are going to consume more rubber. So largely in India, the rubber is produced in southern part of India, Kerala mostly, and a little bit of production also happens in Tamil Nadu and Karnataka. Okay, and the government of India took up an initiative. Okay, and where we wanted some tire companies to participate in terms of providing capital also for helping the northeastern part of farmers to grow rubber. Okay, and so therefore the 4 tire companies in India, okay, and Indian companies, MRF, Apollo, JK, and CEAT, okay, they're contributing a lot to the rubber board for us to grow, for as a country to grow natural rubber in Northeast. So therefore that should help, but it'll take about 4 or 5 years for rubber tree to start producing rubber. So from medium term and long term point of view, that's something which we should help. It may not bridge the gap, but it should help in terms of reducing the gap in terms of import versus the total consumption in India.
Great. I have one more question. I think Mr. Aggarwal can take this. Do you see the margin of tire companies going up in the next few quarters?
I think this was well covered by Ravleen in her presentation earlier, that in Q3 probably the margins may not improve as much as with a big margin, but in Q4, yes, we can expect margins to improve and to a significant level if the raw material prices remain at the levels what it is today or may further go down.
Sure. And the next question, Mr. Kumar had given a brief of it, but probably you can be briefer now. What is your view on the e-vehicle tires demand both in domestic as well as export market?
Export, as of now, we don't have visibility. I'm staying more from CEAT my company's standpoint. Local on a small base, I think it will grow. Two-wheeler was expected to grow faster, but however, I think maybe because of some issues that two-wheeler vehicles faced, and so therefore some momentum is a little bit lost. Okay. On a small base, I think it will grow in strong double-digit percentage going into the next financial year. Beyond that, I think that category will continue to grow in the next 10 years. Okay. And so EV vehicles should grow. I think that is the way to go. And growth will happen more in passenger car in the coming years, in addition to two-wheelers, and maybe as commercial EV vehicle evolves, there also we should be able to grow. So, but that's the future. So therefore, we expect EV vehicles growth to be significant in the coming next 10, 20 years.
Sure. One more question, Mr. Aggarwal. Again, I think it's a reiteration of the margins, I suppose. If there is no major change in oil prices, by when will our margins revert to the long-term average? Mr. Aggarwal, you have to unmute yourself.
Okay, sorry. So with the kind of the current raw material prices, if we can continue, and as I said earlier also, we can go back to the long-term average, which is about, depending upon which company you're talking about, but normally about 12 to 13% kind of margins. Maybe in next about two quarters or so.
Sure. Thanks for that. Mr. Kumar, there's a view on the, there is a question on the capex. If you look at capex increase in the next 5 years, how much is it towards modernization, that is radicalization, and how much is it towards expansion?
So far in the last 5 years, the focus was on expansion. Okay, obviously the newer factories that were set up, particularly the greenfield ones, had little more sophisticated equipment and compared to what existed before we started. Going into the future, Industry 4.0 will play a role in overall configuration of factories. So it will entirely depend on the appetite of each of the tire players. Okay, and digital not only brings in efficiency, but it also may bring in consistency in terms of quality and things like that. My feeling is that about 10-20% of the capex that one would spend in the future should have some relevance to the technology and the digital. Okay, and it will vary from industry player to player. It will also vary from category to category, and that's the way we think in the next 3 to 5 years things would unfold.
Great. Mr. Aggarwal, there is a question from a cost perspective. What can Indian manufacturer do to combat dumping by Chinese manufacturers?
Very tricky question, but I think because we have very low margins at the moment, and if we can continue to demonstrate that the Chinese manufacturers have been actually either selling their products in the Indian market at a much lower price than what it should be, then the government is compelled to actually continue with the anti-dumping duties and anti-subsidy duties. So, and they will not be in a position to dump their products in India.
Mr. Kumar, I think you have mentioned about the inverted duty structure, but there's a question again. Probably you can elaborate. Has the government addressed inverted duty structure? What if the import restrictions goes off? Can it be detrimental?
I'm sure like any other industry, our industry would also look for a level playing field. Okay, and one of the two will have to be looked into. Either you look at keeping the import duties reasonable. You can't have a situation where import duty is very high, 27.5% on natural rubber alone. Okay, and allowing tires to come at a lower rate of duty. Some kind of a level playing field will have to happen. So in the event import restrictions disappear, okay, in the form of say anti-dumping duty on import of tires from say China happens, okay, it will have some implications with respect to utilization of capacities in India. Similarly, in case of passenger car radial tires also, in the event the import restrictions go, the incentive for local automobile manufacturers to source tires from Indian manufacturers, the Make in India concept benefits that the government is looking for may not happen. I don't think in case of passenger cars so much of difference is there in terms of prices. It's more about willingness of original equipment manufacturers to source more from local. The need to import as far as passenger car radial tires by OEMs are concerned is limited. Okay, the need is not there. So I'm sure many of the OEMs are also in the interim period trying to get other local sources approved. But in case of truck and bus radial, happens more on the replacement side. We may the local industry will have to face the consequences of that in the form of lower utilization of capacities.
Mr. Aggarwal, this could be for you. What kind of marketing investments will be required to develop brands in export markets?
So I think this has to be in line with what we have been doing already, about 2%. 2% of the turnover, export turnover, we will have to continue to spend to make inroads into the newer markets. And we have been making efforts all across as an industry, and that is the reason why we have seen that there is a good growth in the export market. So those kind of investments are required to be made.
I think this will go to Mr. Kumar. What is the capacity utilization level across CV, PV, and two-wheeler segments for the industry as a whole?
I'm not able to give you an exact figure, but the sense that we get is that it will be in the closer to around 80% range, okay, at the overall level. What is also happening today is that there's one category of tires which is going down in terms of total consumption, which is called as truck and bus bias tires. So there is a shift happening from truck and bus bias tires to truck and bus radial tires. So therefore, obviously, I think the general understanding is that about 5% kind of a shift happens in the normal year from truck and bus bias to truck and bus radial. So therefore, that may pull down the capacity of utilization of truck and bus bias. Overall, I think approximately 80% is the kind of capacity utilization that we hear based on whatever understanding that we have on the overall tire industry.
Correct. Mr. Aggarwal, how is Tyre meeting sustainability goals? Do you see proportion of reclaimed rubber increasing to meet the goals? Could you speak about circularity initiative of the central government?
So as an industry, we have been working with the government to make it happen, and with the end of the life tire and the kind of the rules and regulations which are likely to be framed soon. So I think that will definitely go a long way, and in terms of having that kind of a sustainability, and also in terms of reduction in the cost to manufacture. So that work is going on along with the government, and probably we will see the guidelines out maybe in some time near future.
Right. I think we'll take the last question because we're running out of time, and this question is to Mr. Kumar. When do you expect OEM sales will be impacted due to the increase in interest rates?
See, particularly in the two-wheeler segment, I suppose it's a little sensitive. Okay, people do buy vehicles on, either taking vehicle loan, okay, or some other options that could be financing options that could be available for them. Interest rates have really shot up. Okay, really shot up in the last 8-9 months, over 200 basis points. So I know it has not yet translated to, banks have not yet translated to increase in their interest rate in the proportion in which the repo rates have changed. But in due course of time, I presume it will happen. There could be a tipping point. I think we are very close to the tipping point. If the interest rates continue to increase the way it has increased in the last 6 months, okay, it may have some implications on the two-wheeler side. Number two, all of us leverage. Okay, all the manufacturers. Okay, the amount of leverage could vary. Okay, so therefore, anyone who's into manufacturing would be borrowing money. Increase in cost of capital is not a good news, particularly for those who borrow money. So from that point of view, it may have some implications in the coming year. In the event that the entire increase in the interest rate gets translated into increase in the interest rate by the financial institutions or banks. So I think there'll be some implications in the coming year, particularly on the lower end two-wheeler, lower end cars, where people borrow money and buy those vehicles.
Sure. I really thank the participants for putting in so many questions, and we are delighted to see the interest in the session. It was an interesting session, and I'm delighted to have views from the industry experts on the sector. Thanks a lot, and I now hand over to Mridul for the closing remarks.
Thank you, Mr. Bhagavath, and thank you, Ravleen, for the presentation. And thank you again to all our guest speakers for their insightful views. Mr. Subbiah, Mr. Aggarwal, it was a privilege to host you. And thank you again to all the participants for taking a time out and being a part of this CareEdge webinar. And we look forward to your participation in future also. For any further queries, feedback, or suggestion, you are most welcome to write us in the feedback mail, which will be coming no sooner the webinar ends. Thank you and goodbye now. I request the tech team to log off, please.